All right, like I said, excuse me, like I said, this is going to be recorded. This is how to protect your portfolio in a market sell-off. Very key on a day like today with the Dow down as much as it was, S&P and NASDAQ all down. This series of webinars, including last week and going forward to next week, has all been inspired by the NYSE getting rid of stop orders. Now, I've never been a fan of stop orders just because there's all kinds of things that goes into that. There's the support resistance that everybody looks at. You know, the big traders know where that is also. And from being on the floor, I know that big money goes after those stop orders. They like to push the market and get those stop orders hit, and then that usually is where they turn around to start buying it. It's no different today with the Citadels and the Algos out there. Those guys know where most of the stop orders are, and they go down there and try and get those executed. That usually creates a bottom. Well, the beauty in options is it doesn't matter where your option is. If the market goes down there and goes through your strike price, you have the option to either get in I shouldn't say get in. You have the option to put that underlying to somebody or trade around it by getting out of that option. So it becomes a tradable event rather than just through market peril, I guess, if you will. And things like the market selling off in Apple recently, you know, you still are increasing the value of those puts as that market sells off. And if it starts to come back or it looks like it's found support and wants to come back, you can trade around that, like trade out of the puts and keep that Apple stock in your core portfolio and lower your overall basis. So, and lowering the overall basis means if I paid $100 for Apple, I bought this put for $1, that increases the basis. So now I'm in Apple at 101 realistically. But if it sells off and those puts increase in value, say to $3, and I get out of that, I've really lowered my overall basis by $2 to $98 in Apple. So that's the beauty in these options. Or if it sold off to, say, 80, just in a bizarro world, then I could put that stock to somebody at 90, 95, something along those lines. So there's a lot of different ways you can play these different options. Last week, like I said, if you weren't here from the webinar or weren't here for the webinar, we did it on puts. Today, we're going to add another component to that, build on that strategy, and sell a call against this underlying as well. So we're going to buy the put and kind of finance that put by selling a call. We're going to collect money for the call and buy the put. So it won't increase our basis as much. And hopefully, in some regards, we can lower our basis because we'll collect a credit. So that's the gist of this webinar. I'm going to be talking about the collar and a conversion a little bit later on if we have a little bit more time. The conversion is where we're going to kind of wrap the same strategy around a portfolio, so you don't have to just go into every individual stock and do this with. But moving forward, my name is Eric Wilkinson. Many of you may recognize me from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years now, and I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your portfolio, and most importantly, control your own risk. If you have your money with a mutual fund or a money manager, at the end of the day, the money that you're losing in paying those different people, you could be increasing your yield in your portfolio by just doing it yourself. And doing a little studying about 20 minutes to half an hour every day or an hour a week, you could probably know as much as they could after a very short time. So don't think that they are the end all and be all of finance. I've traded in most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodities, currencies, and options on all of those products and in all market conditions. That was a crazy day down there. I love that picture. Anyway, I have to go over this little disclaimer. You can take a couple minutes to read this all yourself, but in a nutshell, it's saying that any opinions, news, research, and analysis or other information provided here should not constitute investment advice. It's for general commentary, and it is not a solicitation to buy or sell any of the securities or strategies. At the end of the day, we're here to teach you guys how to swim. We're not here to swim for you. And the reason why I can't give you a strategy or a particular underlying to put into your portfolios because I don't know your guys' risk parameters and I don't know what's in your portfolios. And the reason it just wouldn't be right for me to tell you, hey, you got to go out and buy this stock, because it could be very counterintuitive to what you're already doing. So the bottom line is, do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get this on. All right, this is how to use options to protect your portfolio. And really the idea here is protecting individual underlyings or the full-on portfolio, if that's what you want to do with it, because I'll show you different ways that you can do it. And this is on the collar, and the difference between the collar and the conversion, when I was talking about earlier, a collar is you're long the underlying. So you're long Apple, let's say, just as an example. What you're going to do is you're going to buy an out of the money put, and then above the market sell an out of the money call, and hopefully that call will finance that put. If you were in on last week's webinar, or the last webinar that we did on just the puts, you know, you're laying out money for those puts, and really you're very directional to the downside. You could just lose that money if it never gets down there or it just continues to rally, where this call will help finance that. So you're not laying out a lot of money. The difference between the collar and the conversion is the conversion, you really don't have this underlying that you're protecting. You're just buying the put and selling the call, and it's very directional to the downside. Whereas when you're long the underlying, it is more of a market neutral to bearish, but you still make money on the upside as well. And I'll show you how that works out. So just because you're selling that call doesn't necessarily mean you're getting out of all the upside potential in that underlying. If it goes through your short call strike, it can continue to rally and you'll be all right. I'm sorry, I skipped one. All right, so the essentials to success for the collar, as well as most option strategies that I talk about, picking the right strike. And with this particular strategy, picking the right strike, I am usually looking at one standard deviation, which if you've watched many of my webinars, I talk about the bell curve, and one standard deviation is a 16 delta, which means that the probability of being out of the money at expiration is 84%. It's really taking that delta and subtracting it by 100. That's your probability of being out of the money. And with this strategy, I don't really want either one of these to really get hit. But the one standard deviation, 16 delta, is usually where I'm going to start on the put side. And then I'm going to look to the call side to see where I can at least get that amount that I paid out for the put. Does that make sense to everybody? So I'm going to start with the 16 delta on the puts, and then the calls, because there's a lot of skew to the puts, especially right now with the market going down, the puts get premiums pumped into them. The calls could be a little bit tighter, especially after you've already made that move. And picking the right duration. If you watched last week's webinar, we did it on puts. We were looking at the further duration, because when we're buying options, I don't want to see a lot of decay happen in those options. So I'm picking a little bit further away. With this strategy, I'm going to be looking anywhere between 60 and 45 days, because the decay on the calls is going to be relatively the same as it is on the puts. And if I haven't had to lay out a lot of money, I'm not as concerned about the theta decay, because it's I'm getting theta decay on one and the other at the same time, so they're kind of offsetting really. you're going to have positive theta decay and you're going to have negative theta decay on those strategies, because the negative theta decay happens on the buying, the negative theta decay happens on the buying, the positive theta decay happens when you're selling those options. So they're going to kind of offset. It's not going to be a perfect world, but it's going to be very close. So we're going to be looking between 60 and 45 days. Now, I've shown this chart quite often, and this is the theta decay along here. So I'm going to try to get like right around in here and then let it ride in, slide into the slope. So I can go out 60 some odd days. Once you get inside this 28, 21 days, you start seeing a lot of that theta decay, but I like to give myself a little bit more time playing around in this 60 some odd days. And a lot of options don't have the February contract right now. As of Monday, those February contracts will start popping up for some of the stocks that didn't have it already. So that will give you that 60 some days out. All right, and picking the right environment. You don't really want to do this in a full-blown bullish market where the stock is going straight up, because you're going to get run through on those calls, right? I mean, everybody's looking for the upside, but when the market is at historical high for the underlying, or the market, what I mean by the market is the market that you're focused on. If it's Apple, if it's Google, if it's Pfizer or something along those lines, McDonald's, that's what I'm talking about, that particular market. Or if you wanted to protect your overall portfolio, the market in general, the S&Ps, the NASDAQ, the Russell, or something along those lines. And you would want to protect that portfolio wherever you're weighted to. So if you're weighted to techs, you would want to go into the NASDAQ. You wouldn't really want to hedge your tech-heavy portfolio with the S&Ps, let's say, or the Dow. And picking the right underlying. So if you are heavy in a particular stock that isn't widely traded in the options, you really wouldn't want to pick that option cycle. So you could find something that is very closely correlated, that has a lot of options traded in it, and use that as a surrogate, I guess, if you will. So make sure that you're picking the right underlying in these options, because if you have to give up a lot of edge in the options contract, that's not going to behoove you when you got to get in and out. You're going to be eaten up on giving up a lot of edge. I was talking about it in one of the daily market commentaries, where Pandora had that big move just a couple of days ago, and I had to really give up a lot of edge just because there, were really wide markets in there. So that's a situation where I had to give up a lot of edge to get in and out of it, despite the fact that I thought it was a pretty good underlying. But when things get crazy, those markets get a little bit wider. All right, so and know your exit strategy before entering the trade. So what this means is we're kind of going to be looking for that same 50% of max profit that I always talk about, or a loss of 2 times the credit that you received. That's a little bit wanky there, but that's kind of a general rule. The credit you receive is going to be very little, so that's not really going to always be what I look to. So the credit, that's kind of along the lines of something else. So when we're doing just the puts, so or selling option strategies, but I'm going to be looking for this to be more of a trading environment. So if the market goes down, if I'm going to get 2 times what I paid for, I should have said, that put, then that might be the time where I start taking off the put. Or if that call is worth nothing anymore, I might roll out of that call and roll it down closer to where the market is trading and collect a little more premium for that. Try and make up for some of that loss I'm seeing, because the puts aren't going to make up for all of the loss that we are seeing on the downside if we're looking to trade around that. All right, so the max profit on a collar is your short strike minus the underlying price plus the premium. Now, if you've collected a premium, then you're going to add that to the underlying, so you're going to add that. If you're paying out a debit, you're going to subtract that from the underlying. Actually, I said that backwards, sorry. If you're paid a debit for the strategy, you're going to have to add that to the underlying price because your basis goes up. If you collected a credit for that, then you are going to subtract that from your underlying price because it lowers the overall basis. Gary's asking where will the recording be placed. It should be being sent to you guys in your email probably a couple hours after. And one thing I forgot to mention is when you get this recording, especially if you're new to options, watch this again, you guys, because it makes it really sink in. If you wait a week or 2 weeks down the road, it's just not going to stick as well as if you watch it again. And it's because a lot of this stuff will go by you really fast. The next time you go over it, it'll all really make it start to sink in. Okay, so the max loss, your max loss is the underlying price minus the long put minus the premium. Now again, you're going to have to flip that. If you've collected the premium, then you are going to have to add that in, and if you paid a debit for it, you're going to have to subtract that from there. It says he needs to watch it 5 times. Sorry. That does help though, you guys. It does help. Believe me. I've been there too. And the break even is the underlying price plus the premium. And you're also going to have to, take into account your commissions. Don't forget. All right. So I've gone through those slides. I've got a couple of other ones, but I wanted to get into the platform here. So, we've had a lot of things going on today. So I have Apple on here. Let me get up a good chart. So do most people have Apple in their overall portfolios? So here's something that I've talked about in one of the other webinars also. This is a correlation study where it correlates it. I have it correlated to the NASDAQ or the QQQs. And, it's 100% correlated. Obviously, the Qs are correlated to the Qs. But you can, if you are heavy into tech, what you can do is if you have maybe a unbalanced weighting towards one of these stocks that's very correlated to the Qs, then you could supplement one of these one of these stocks and have it be a surrogate for the broader market. So if you were, say, really heavy into Pfizer and then you had a lot of other ones that were very tech heavy, then you could probably use Pfizer as the surrogate for that. And one thing that you can do on that is this is the way to, whoops, did I lose that one? Sorry. Let me go back. So sorry about this, guys. My slideshow went bonkers. Let's see, do I still have the slides on here? So I think I lost my slides, but anyway, the overall, there we go. Let me make sure I got this going because I think I just lost my slides for some reason. Sorry about that, you guys. I wanted to show you guys this slide here at the very end. So this is a way to kind of figure out how many of the underlying you need to do. So for instance, if you have $100,000 portfolio, and that would be that you have $100,000 worth of stocks in that portfolio. If you wanted to hedge that entire portfolio, what you would do is look at the SPY, if it was mostly in the SPY, and it was right around 101 when I was doing this up, but the market sold off since then. So you could say 200, let's just say, to make math easier. So 200 times 100 is 20,000. So you would need to do 100,000 divided by 20,000 is 5, right? So 5 SPY contracts to hedge that. And yeah, and Glenn or Gary's asking about a collar on Oracle. Yeah, I'll do Oracle for sure. For instance, Oracle is trading around what, $30 ish. I could look real quick. We could look on this. What is Oracle? I know I got it up here somewhere. I can just go like this. Yeah, $36. So you would do $36 times 100, and that would give you 3,600. So 3,600 divided by 10,000 would be, you're looking at around what, 50 some odd contracts. So you would want to do 50 contracts if you had 100,000, say, but you were really heavy into Oracle. So you could do it like that as well. Plus, or if you were, say, you had Goldman Sachs, Goldman Sachs is really correlated, so you could do the same math on that. 175 times 100 would give you 17,000, so it's just a little over 5 contracts-ish, right? And always under hedge this, you guys, because the market does have a tendency to go up more than it goes down, right? So you want to under hedge a little bit, especially with this strategy. Okay, so let's look at Oracle for a collar. So let's just say, Gary, can I use you as an example? Where are you long Oracle? Everything took a bath today, especially the financials. Market's having a fit that the Fed raised rates, and now they're probably going to have to ease. Okay, so all right, so our example is 20. He's long at 20, so he would definitely want to protect some of these gains that he's had. Now, I would look at it on a chart and maybe even go back a little bit further and see that this should act as a support right here around 35. It wanted to bounce up here, and so 35 to 40. It's in a nice tight range despite the fact that it's really taken a beating this week. So if we were going to want to protect our gains on this, we would want to sell a call up there around 40-ish and maybe buy our put, because if it goes below this 35, it could get a little ugly. So I can go over here. This is the market profile. I always look at this too, because it gives you a really good idea as to where the market has been trading really quickly. This gives you the idea. This is the point of control, is what they call it. It's where the most time and value has been spent. Now it's broken below the value area low here, which means the bears are pretty much in full control here. It could want to bounce and build this out right here, but as of right now, all the people that bought it up here at the point of control, which is a lot of people got in, obviously, those people are underwater now, and the further we get away from that and below this support level, people are going to want to exit rather quickly, especially going into the year. That might be where they take their losses for the year. So this would be a really good example as to where we would want to be very cautious. So we're long at 20. So we're going to go back into, so this is saying about 38.5 is going to be acting as resistance too. So just to have that in our mind, 38.5, and it should find support around 35. Just because, as you can see, it's done several times down there and tested that, and that seems to be the support level. Plus you have this 200-day moving average. It's right on. So let's go into the trade page. So we'd be looking at Oracle. It's right at that 28 days. We might want, okay, so Oracle does have the February. That's good. So the 35 is right there at that 10 delta I talked about. So I would be looking at buying these 35s, and then since I'm getting 80 cents for it, I would be looking to collect a little bit more. So we're going to have to go a little bit tight to the 90s to try and at least collect a premium and lower our basis. Okay, so that's what we want to do. So I would be looking to buy the 35s and sell the 37s. Now, if you think that there's going to be a real quick rebound, you might pay a little bit, 30 some odd cents, since you are in so low, or since, I'm going to use everybody as an example. I'm going to say we, since we bought this at 20, let's say, we could easily give up a few penny or 30 cents or so to get into this to protect on our upside. But 35 to 37. Now, what happens if this goes down? If you guys watched last week's webinar, you noticed that I was way down here on these, and I bumped up my deltas to get to the amount I wanted to hedge. Say I would do 5 contracts on the puts to get to 60 deltas to hedge a little over half. When we're doing this by doing the 35s, we're only really hedging 33% of our downside risk. Now, what does that mean? So for every dollar that Oracle goes down from here, we're only going to capture 33 cents for every dollar. Now, when it goes down a dollar, the next dollar down, you're going to add this little number to it. So as you can see, it's 45. So that's the same thing. So it's going to go up to about 43-ish. So you're going to add these numbers into the deltas. That's how that works. It's called the gamma. The gamma is the next dollar move. So first dollar is 33 cents. The next dollar, it's going to help us 43 cents. The next dollar, it's going to help us 55 cents. Does that make sense to everybody? That's what this gamma means. It adds into the delta for every dollar move. Same as it goes up, then you would subtract the gamma from that. So if it goes up a dollar, that delta goes down to 23 cents, the next dollar up. Okay? I don't want to get too over everybody's head, but that's how that works. So the closer we get to at the money, that gamma really starts helping us out. And then once it gets to 100, as you can see, you can't go over 100, or over 1, I should say. And that's why the gamma is 0. And you're dollar for dollar. For every dollar it moves down from here, then you're gaining a dollar in your premium. So some people like to go up here and buy these puts deep in the money. I'm not a huge fan of that. Because I don't want to lay out a lot of money. The thing with this 35, let's just say you can go up here into theoretical price and mark, and you can change this stuff around. So let me reset everything. So let's just say on a couple of days, Oracle does go down another dollar. So if it continues to go down in price, right, let's say $1, it's going to give me $10, goes down by $1. So you put a negative sign in there. And let's just say volatility continues to increase, because I would have to assume in a market that's going down, the volatility increases, even though Oracle hasn't done that. Oh, is that on the day? Yeah. It's surprising that Oracle has sold off that much and the volatility has come out of it. That usually doesn't happen. Usually when the market's falling like that, your volatility will increase. So another benefit to doing this right around now, because if it does fall, that volatility will probably start to go up even more. So if the volatility goes up by, say, 5%, I'm going to be a little reserved here, just because that 5%, if it's going down, I don't want to get too crazy with it. But if it goes down by $1 more and goes to $35.50, we're going to get an extra 60 cents. So we lost $1, but we gained 60 on the down move. Does that make sense? So I increased the volatility, which helps a lot, because as volatility increases, the premiums get pumped up more. So, you would gain 60 cents on the downstroke here. You're not in the money. You're not really in any peril at this point, but you've gained 60 cents. You lost 40 cents on the downside, but you're protecting a lot of that. And keep in mind that these calls that we sold at 37, if it went down $1, because the volatility increased, you're going to see those premiums come off a little bit, but not as much as if we saw the vol contraction. So you would gain an extra 20 cents there. So just keep that in mind, that these calls become worth less, and then you're making money on that side too. If, for instance, this went down by $3 or $4, let's say, volatility increased by 5. Now, keep in mind, these are in the money now. These puts are in the money. So, and they're in the money by, we went down $4, so it's trading 32, 36. So we're in the money by a few dollars. And this has gone up by, what is that, 4 times? Almost. So you've gained $3 or you've gained, sorry, $2.60 on a $4 move down, but these calls are also now only worth 15 cents. So you've made some money there. Now, when it keeps going, you could look, if it went down $4, let's say, you could look to cover the puts and sell those puts out for a profit, and then just collect that premium. So now your overall basis for that $20 stock is really $16, right? Because you've right around $16, because you've collected, or sorry, $17, because you've collected almost $3 for that overall strategy. Does that make sense how that works? Now, if it continues to go down, then you're not participating anymore. It's not helping you anymore. But if it looked like it was bottoming out, like we came and looked at that one, those couple of charts, like for Oracle, where was my other article? So below 35, that's going to be finding support. So if it goes much below that, I might look to leave that on. And if it just came down to that 35 area and sat there for a day or two, then I might even look to cover that. So, that all ends up being more of a game time decision for you. If it looks pretty ugly, but this has kind of done a bit of a hammer here, and it's right up against that, I would have to say that this is starting to find some pretty good support right in here. So, but if it goes below this area, I would be worried. So, you do that strategy now, and if it comes down and gets below this by very much, then you just leave those puts on. If it comes down here and kind of settles down like it did here, then that's where I would look to cover that. Does that make sense for everybody? It's not that easy to just help you make the trades. Well, Gary, if you're signed up for the class and you have questions, I would be more than happy to go back and forth with you to help you out, walk you through this a little bit more too. So, but basically, the idea is you're trading these options around your core portfolio, like your Oracle that you've had on for a very long time, you guys. So I have a core portfolio too, and I don't want to get out of that. I don't want to, I don't want to take that tax consequence for one. So I'm always looking to trade around these. So if I'm deep in the money on these puts, I'm going to look to cover those puts at some point in time. I don't want it to be put to somebody necessarily, because I want to keep that stock. Maybe I want the dividend. It has a good dividend or something along those lines. So I'm going to look to trade around that. So that's the way I always view everything. And if you don't have a core portfolio, then another strategy you would look at that would be comparable to this collar is just doing long call spreads and low implied volatility. So that's another comparable. So if a lot of people are just using option strategies, the other strategy that is exactly like the collar but just using options is getting long a call spread. So that's an altogether different webinar. But with this, I would look to buy the 35 puts, which we talked about, and then selling those calls to finance it. Now, if you're really bullish, then I would look to pay a little bit of maybe a debit if I thought, I don't want to be that tight, and have another just 50-cent move up, and now my calls are looking to be in the money. Then you could push it up a little bit, and you could push these puts down a little bit to get that equaling out, so you're not really paying anything for it. Because as you can see here, even these further out of the money ones, for 40 cents or whatever, it's gone up by $1.50. So rather than $2 or that much more. But keep in mind, you're not seeing, it's not protecting as much because you're just doing one lots on these. So if you did the 40 call, you're going to collect 15 cents because I'm just going middle market, and here's the middle market, I guess. So I would be collecting 50 cents. And if you did the 35s, you would be laying out 65 cents if you did the 35 calls. If you did the 34 calls, you'd be laying out or paying a debit of 35 cents, which you have to multiply by 100. That'd be $350 to protect it. But if it does go down to this 34, then you're collecting an extra $200 for the down move. Although you've lost, a little more than that on the down move on the underlying price. Now, what I was talking about, if this goes, because, the deltas on this strategy is, not as much. On the upside, you're still participating on the upside. So even if you sold the 40 calls for this instance, it's only going to increase in value 12 cents for every dollar up move, and then it'll basically, the next move is 9 cents because you're adding that, or 19 cents because you're adding that 7 cents in there. So you're still participating on the upside, but it's not as much. It's not dollar for dollar, right? So it's 88 cents the first dollar up move you're participating on. The next dollar up move, you're participating on 80 cents of it. So that makes sense because I'm subtracting this delta from the dollar move. So if I have a dollar move in the underlying from $36.35 and it goes to $37.35, really I only participated on almost 90 cents of that move. So it would really only be, if it moved up $1 to $37.35, I would be participating on $37.25. Does that make sense for everybody? All right. Okay, good. So keep that in mind. That's what the deltas mean. Now, the further you go here on the deltas, it's closer to a 50-cent move. If it went up $1, I would only participate on 57 cents on the upside. So that's also why I like to go a little bit further out. You don't participate on the downside as much, but I'm also looking to trade out of this. When I see it come down to my support level, I'm looking to get out of the option, not necessarily the underlying. I want to keep that stock in my portfolio. Does anybody else have any stocks that they want me to look at that answer your question, Gary? The options are pricing in right here. You know, if you look at this as going from $36, usually they're in markets where we've gone down, they are pumping the premiums up because people are buying the option. They're doing the strategy. They're buying puts and they're selling the calls. So that's why those get pumped up. One thing. Yeah, Sergey, remind me at the end, and I'll talk about the calendar a little bit later when we get through this a little bit. You're asking if there's a book that you can read, but I haven't written one yet, Gary, so no, I'm sorry. Or at least I don't know if there is one. All right, so let's look at Amazon. Because I think if we do more examples, it'll be a little bit more clear. Now, Amazon is a big dog. And, you know, you're hedging a big contract, so you're going to be paying, you know, bigger premiums for that, and your margins are possibly going to be bigger. Right when you'll buy it? Okay, good to know. I've at least sold one book then, right? All right, so same thing I would look at again on this one is I would look at somewhere like the 10 Delta because, you know, Amazon has huge moves. I mean, $6.50 move in Amazon is really not that unheard of. And it's, you know, as you can see here on this up day, you know, went from 41-ish to 60, so $20 moves. I mean, Amazon has huge moves. So when you're looking at the options chain, you have to keep that in mind that, you know, in the next 28 days, the volatility is predicting that Amazon could move $46. So when you get further out, and I'm looking at the 10 Delta, you know, a $20 move or $30 move puts me right at that option. So it seems like you're moving way out the option chain, but in retrospect, you're really not that far away. A $6 move in Amazon is big for some stocks, like, you know, a $100 stock, maybe like Disney got spanked today. Was down like $4 or something. But you know, that's a big move for that. But $20 move in Amazon is not that unheard of. So you would be looking at, say, this 590 stock, and it also depends on where you got in. Like if I bought Amazon at 600 or maybe 630, I probably would be more aggressive with this strategy and get it a little bit tighter. If I bought it today, if I bought Amazon today, I would probably be buying something around these, you know, 18 deltas because I wouldn't want to take that much heat. So but assuming that we bought it below here at the beginning of the year, let's say, and we really want to protect our gains, I would be looking at buying these 590s, and I would also have to say 600 would be a psychological level that the bulls would want to protect. So going just below that, get in right here at this 590, pay $3.10, and then I just go right to here and I just look for where I can collect. If I could get this call for zero outlay, then I would probably do that and put that in as a strategy, just, you know, net zero credit or debit. So I like to try and collect a little bit, so I would try and put a cap on it at 730. The thing with the calls are also, you guys, is, you know, Amazon's at historical highs here. So if it got up to 720 really quick within the next 28 days or so, I would be happy to sell Amazon at 720 and be out of it. You know, I might just do that and then look to have a pullback and get back into it. Depends on how long you've held it. If you've held it since it was, you know, 300 and you're doubling it this year, you might not want to do that. You just probably cover your calls, and you just didn't fully participate on the upside. Does that make sense? Because those calls you sold are going to increase in value, and those puts are going to expire relatively worthless. So your only risk there is that you still participated on the upside, you just didn't participate fully on the upside. And since those options on the 720s, you're going to participate, 70 cents on the upside, because next dollar up or next $5 up, it's going to decrease a little bit, but you're still participating on the upside. You probably have to average it out, and you probably participated out of the 720, maybe 705, so 2/3 of it. That makes sense? Yes, this is the calls over here, and this is the puts. And the gray is in the money, and the black is out of the money. Gray in the money, out of the money. Because remember, if you're buying puts, you're buying it because you're thinking it's going to go down. So these are in the money for puts because it's already below that. And the calls, you're in the money because you expect it to go up. Does that make sense for everybody on this? So the idea here is to do this strategy for as little as you would have to pay out. If you're paying out a couple of pennies, that's okay. I always try and look to collect a little bit of a credit, because then I lower this overall basis. If I collect money, it means I paid less for the overall stock. And this strategy is still good because even if it rallies up, if the stock goes up by that theoretical, let's say $5 or whatever, you can see the options are increasing, but it goes up by $5. I've only lost 30 or 25 cents, because here's the mark, 35 cents, 25 cents, sorry. Does that make sense for everybody? So try to do this, and if you watch many of my other webinars, you know that I'm always talking about, I would probably even go to these Februaries for the most part for most of these strategies. The implied volatility percent isn't as important on these as it is like last week's, where I wanted really low implied volatility, because as implied volatility goes down, so do those premiums. So if I pay money for something, I can be directionally right. If that premium comes out of it really quickly, I can be directionally correct, the market goes down, but I still didn't make any money because the premium comes out. With these, because we're selling a call and we're buying a put, our theta decay ends up kind of offsetting each other. So for instance, when I said we're going to be looking at the 10 delta here, which is the 590s, as you can see, our theta decay is 20 here, negative theta decay of 20 there, and then our, what did I collect there? $3, so I said I'd go to about here, and our theta decay here is 18. So that's really close. The decay is going to be relatively close. If you really wanted it to be exact, you could just go down, but you're paying a debit. I'd rather not worry about that as much and not pay out. Does that make sense? So that's the gist of this strategy. And if you wanted to just not hedge your Amazon and wanted to hedge your overall portfolio, you could do it with the SPY if that's where most of your stocks lied or were lying. And if you were heavy in tech, maybe you would do the Qs. And the Qs is 100, so you would have to do 10 of them. I would probably do 50% of that, maybe do 5 to 10 Qs to hedge my overall portfolio, somewhere in there. Does that make sense for everybody there? Sorry, I just scrolled off. Okay, good. All right. I mean, this went relatively quickly. All right. Are you still here? Can you still hear everybody? Okay. All right, good. Does anybody have any questions real quick? I know I kind of went over this real quick. I know Sergey wants me to go over something about the calendars real quick. And I'll stay on a little bit longer, Sergey, and run over that once we get everybody's questions out of the way. How do I set up the correlation side? You go into this gearbox, customize, and click on that, and then you can pull over strength meter. I pulled over the correlation. You just type up here COR, and it'll probably start populating it, and then you just say add that item to the side and make sure you adjust enough room for this. Same thing with the implied volatility. This is the most important thing I ever look at for almost all my strategies, is the implied volatility percent, which is when the premiums are really pumped up and you want to sell strategies against that. You can go to customize and pull up IV percent over here, and it'll add it, because that's the most important thing you do, because I don't want to buy call spreads or put spreads when the implied volatility percent's high. You're only going to sell those anywhere below 30 when it's way down here at the bottom. Then that's where I'm going to be doing my buying strategies. So make sure that if there's any takeaway you take away from today, when you're buying strategies, make sure the implied volatility percent is low, and when you're selling strategies, make sure it's really high. And right now we have a lot of high implied volatility percent. If you watch my daily market commentaries, for a while there I was just like struggling to find anything where I could sell strategies. So then that's when I would revert to buying it, if it's less than 10 or something like that. Yeah, TOS has good scans. Definitely has good scans. Makes life easier. All right, guys. And Sergey, stay on for a little bit. I'll go over this a little bit more in detail for you in a minute. But I just want to thank everybody for attending today's webinar. Future webinars, we're going to be drilling down on other option components, how to trade options and trades I find. If you watch the daily market commentaries, I'm always talking about the trades I find, and I tell you when I get in, exactly where I get in, and I tell you where I get out. So you can follow that, and if you want to enter those trades, you have to, that's on you guys, okay? And here's a link to the special options courses. It's also in the chat box, so if you go down and click on the chat box there, there should be a link for the special options course offers. I just want to thank you, and if you have any questions, contact us at 310-598-6677 or email us at trading@protraderstrategies.com. Like I said, if you guys are signed up for the courses and stuff like that, I am more than willing to help people out. I've done it. If they have questions, comments, or ideas as to what they want to hear in a future webinar, we'll definitely look into that. But if you have questions as to what you have going on in your portfolio, if you're getting tested on something, then I will definitely tell you what my actions would be for that. I can't tell you what I think you should do, just so you guys know that. It's and that's not just me saying that. That's like the SEC and everybody else says that I cannot give you advice. I can tell you what I would do, and if you do that, then we're all good. But just so you guys we're clear, I can tell you what I would do in a situation, and it's up to you to do what you would do. All right. Thank you guys all, and Like I said, next week we're going to be doing one. I think it's going to be a little bit earlier because of the holiday session. So I hope you guys got a lot out of this. And if you can't take that, take it easy. All right, so I'm going to go over what Sergey was talking about. I gotta read it all real quick. But Sergey, could you please explain one thing regarding the calendar? In particular, question: what will happen if the front month short put is in the money and was not closed out before the market closed? In addition, account balance is not enough to handle the execution. Okay, so Sergey, I mean, it sounds to me like you're having a margin call. So are you debit then? Can you answer that, Sergey? Thanks, Donna. Thanks, Raymond. Appreciate it. You guys take care. Okay, so you bought, are you saying HTM or in the money? You bought an in the money put? Are you saying you bought the in the money put? Okay, so you have bought an in the money put in what? You bought a, wait, I'm confused, Sergey. You say I have bought HTM put in February. So you sold, what underlying did you trade, Sergey?